Imagine walking into a home that feels normal. It's a four-bedroom colonial in a quiet, leafy suburb. The kitchen hasn't seen a renovation since 2019, and the car in the driveway is a sensible, 5-year-old sedan paid for in cash. This is Liam's house. At 46, Liam works a steady 44 hours a week, enjoys 3 genuine vacations a year, and possesses a temperament so detached from market volatility that when the S&P 500 plummeted 28% in 2022, he went for a jog and didn't check his brokerage account for a fortnight. Liam's net worth is $1.84 million. Now, drive 3 miles away to Harry's house. It is stunning. Harry's kitchen was a $47,000 masterpiece completed just last year. He leases a high-end German SUV, and his home, worth $850,000, is a fortress of luxury. But inside, the air is heavy. Harry works 58 hours a week to maintain a lifestyle that looks like a success story, but feels like a hostage situation. He earns more than Liam nearly every year. Yet at age 46, his net worth is just $312,000. Same city, same starting line, same decade of opportunity. One man built wealth. The other funded the appearance of it. This isn't a guide on how to make your first dollar. It's a breakdown of the 10 invisible traps that wait for you once you've already started winning. The traps that are invisible when you have nothing, but become brutally expensive the moment you have something to lose. Trap 1. The acceleration of lifestyle creep. We often think of lifestyle creep as a slow leak, but for high earners, it's a flash flood. A 2025 Goldman Sachs retirement report revealed a staggering statistic. Among households earning between $250,000 and $500,000, roughly 43% live paycheck to paycheck. Even more shocking? For those earning over $500,000, the rate remains nearly 40%. This is the Diderot Effect in action. Named after the French philosopher Denis Diderot, who received a beautiful scarlet robe as a gift and soon found his existing furniture looked shabby in comparison. He replaced the chair, then the desk, then the rugs, ending up in debt to match the elegance of the robe. In modern terms, you upgrade the house, then the furniture looks cheap. You fix the furniture, and suddenly your car feels embarrassing at the country club. The fix. Implement an investment-first raise policy. If you receive a $20,000 bump in pay, $12,000 should be diverted to your brokerage or retirement accounts before you even see it. If you don't feel the money, you won't find a way to spend it. Trap 2. The soulmate asset. Overconcentration. This trap targets those who have already been successful. You bought a tech stock early, or your company gave you equity, and it soared. Now that one asset represents 50% of your net worth. Selling it feels like a betrayal of the thing that made you. Consider Intel in the year 2000. It was the undisputed king of silicon. At its peak, it hit $75. Within weeks, it dropped 36%. 25 years later, it still hasn't recovered to those highs. J.P. Morgan's analysis of 13,000 stocks found that 40% of companies suffer a permanent decline of 70% or more from their peak. The rule: never let a single position exceed 10% of your total portfolio. The moment an asset becomes part of your identity, It stops being an investment and starts being a gamble. Trap 3. The silent bleed of tax inefficiency. Taxes are likely your single largest annual expense, yet most people treat them as an afterthought. Imagine earning $60,000 on a brilliant trade. If you sell in month 11, you could owe nearly 40% in short-term capital gains. If you wait until month 13, that rate could drop to 15% or 20%. That 2-month wait is worth $10,000 in pure profit. Morningstar found that the average equity fund loses 1.48% of its returns annually to tax drag. Over 20 years, that can reduce your final wealth by a staggering 35%. The strategy: use location optimization. Keep high dividend stocks and REITs in tax-advantaged accounts, like an IRA, and use taxable brokerage accounts for long-term growth stocks and municipal bonds. Trap 4. The mirage of early success, overconfidence. Psychologists call this self-attribution bias. We credit our wins to our genius and our losses to bad luck. After a couple of good years in a bull market, many investors stop buying boring index funds and start trading options or buying on margin. The University of Salo tracked 20,000 day traders over a year. The results were harrowing. 97% lost money. Only 17 individuals out of 20,000 earned more than the local minimum wage. A rising tide lifts all boats, but it doesn't make everyone a captain. The protection. Investing should be boring. If your portfolio feels exciting, you aren't investing. You're seeking entertainment, and Wall Street is a very expensive theater. Trap 5. The habit of excessive labor. There is a point where your time becomes more valuable than your labor. If you have $5 million invested at a 5% return, you are making roughly $684 every single day, including weekends and holidays, just by existing. Bronnie Ware, a palliative care nurse, found that the second most common regret of the dying was, "I wish I hadn't worked so hard." Many high earners continue to grind 60-hour weeks out of habit, failing to realize they have already won the game. They are trading the only non-renewable resource they have, time, for a resource they already have in abundance, money. Trap 6. The illiquid millionaire. Being paper wealthy is a modern epidemic. Bloomberg data shows that households with a net worth between $1 million and $2 million often have 66% of their wealth locked in illiquid assets, home equity, and retirement accounts. If you can't access your money without a 6-month real estate closing or a 10% IRS penalty, you aren't truly free. You are house rich and cash poor. Ensure you have 3 to 6 months of expenses in a high-yield savings account and maintain at least 15% of your net worth in assets you can liquidate within 30 days without massive tax penalties. Trap 7. The omission of umbrella insurance. As your net worth grows, you become a target for litigation. A simple car accident or a slip and fall at a dinner party can lead to a judgment that exceeds your standard auto or home insurance limits. 13% of personal injury awards now exceed $1 million. An umbrella policy provides an extra $1 million to $5 million in coverage for a few $100s a year. It is the cheapest way to protect $1 million portfolio from a single bad day. Trap 8. Fake diversification. Owning 5 different growth ETFs isn't diversification. It's concentration with extra paperwork. In 2008, correlations between different equity classes spiked to nearly 70%. When fear hits, everything moves together. Real diversification means owning assets that react differently to the same news. This includes international exposure, real estate, and perhaps private equity or commodities. As David Swensen, who managed Yale's endowment, proved, the secret to massive growth isn't more stocks, it's uncorrelated assets. Trap 9. The scale of loss aversion. Losing 20% of a $50,000 portfolio hurts, but losing 20% of a $2 million portfolio, $400,000, triggers a primal biological panic. Our brains aren't wired to see paper losses at that scale. They see a life-threatening catastrophe. This leads to panic selling. In March 2020, investors pulled $326 billion out of the market at the exact moment it bottomed. They missed a 70% recovery because the dollar amounts had become too large for their rational minds to handle. Automate everything. The less permission you give yourself to make decisions during a crash, the wealthier you will be. Trap 10. The absence of an estate plan. Building wealth is one skill. Ensuring it survives you is another. When the artist Prince died in 2016 without a will, his $156 million estate was ravaged by 6 years of litigation and $87 million in taxes and legal fees. Over 56% of his life's work was consumed by administrative chaos. Only 26% of Americans have a will. Without a plan, you are leaving your legacy to the state's default settings. A revocable living trust and updated beneficiary designations are not just for the ultra-wealthy. They are for anyone who doesn't want their family's future decided by a courtroom. The 2 different games. Harry isn't a failure because he's lazy. He's struggling because he didn't realize the rules changed once he started making money. Liam reached $1.84 million, not through a lucky break, but by avoiding the invisible friction of these 10 traps. The enemies of your wealth aren't usually market crashes or bad luck. They are the quiet creep of your lifestyle, the emotional attachment to a single stock, and the deferral of boring tasks like insurance and estate planning. Look at this list. Identify the one trap you are currently standing in. Don't try to fix all 10 today. Go fix the one you recognized. Whether it's setting up a will or diversifying that one giant stock position, take the action today. Building wealth is a marathon, but protecting it is the finish line.